Hi, I'm Elliott, and this is a photo of Lehman Brothers employees leaving work for the last time. This photo was taken shortly after the investment bank filed for bankruptcy on September 15, 2008. The 1973 to 1974 OPEC oil embargo helped cause the vicious recession of 1973 to 1975. That recession drove a bear market where the S&P 500 plummeted 48.2% over 20 months. Warning: there have been 12 bear markets in the U.S. since 1937, and the average decline is a whopping 35.5%. So you must avoid the next bear market if you want to generate real wealth out of the stock market over the next few years. However, I also must warn you that the S&P 500 jumped an average of 24.5% in the final 12 months of all U.S. bull markets since 1937. And it was up a shocking 58% on average in the final 24 months of these rallies. Sell out too early and you're doomed to underperform. In fact, missing the final melt-up bull market cycle is just as bad as holding on too late through a major recessionary bear market. That's not what I desire for you. So you might be wondering how you can spot wealth-robbing U.S. economic downturns and bear markets before they start, so you know when to get out of stocks before it's too late, while still enjoying the most profitable final melt-up stage of the bull market cycle. Listen, I've developed a 10-point checklist that I use to do just that, and today, and only as part of this short presentation, I'm going to reveal one of the simplest and most reliable points on my checklist. This simple indicator, available absolutely free of charge to anyone with access to an internet connection, has a near 60-year track record of helping investors spot major U.S. economic downturns and bear markets before they happen. Keep watching this short presentation through to the end, and I'll reveal what this simple indicator is and how I use it myself. I'm not exaggerating when I say that this short presentation could mean the difference between devastating losses in the coming bear market or preserving and growing your wealth by investing in the right stocks at the right stages of the cycle. However, before I get into all that, I should probably introduce myself. As I said, my name is Elliott, co-publisher and chief analyst for Deep Dive Investing Research. You may or may not have heard of my work or that of my firm. Over the last 20 years, I've made my career using powerful yet predictable market cycles to forecast major trends in stocks, commodities like oil, corn, and gold, even interest rates, emerging markets, and the U.S. economy. 12 years ago, in a book I co-authored, entitled The Silk Road to Riches, I used my research on agricultural cycles going back to 18th century England to call a tipping point in demand for meat. That tipping point, led by growth in emerging markets like China, propelled the prices of key feed commodities like corn and soybeans to record highs in 2012, producing gains of 763% in fertilizer producer Potash Corporation, 94% in oilseed processor Bunge, and 296.4% in an under-the-radar palm oil producer based in Belgium. In late 2008 and early 2009, while many talking heads in the financial media were calling for a second Great Depression, I called the bottom in global stock markets and recommended loading up on names like consumer finance firm Discover Financial Services, up 582.8% since the end of 2008. Railroad giant Union Pacific, up 387.1%, and even home improvement giant Home Depot, up 345.6%. More recently, you may have heard of the work we've done helping investors avoid the pain associated with the collapse in oil prices and disastrous declines in many energy stocks and master limited partnerships since the summer of 2014. 3 years ago, with oil near $100 a barrel, some pundits scoffed when we called for oil prices to eventually break down to $30 a barrel or lower. However, the critics were silenced when our timely sell calls and popular energy high flyers such as deepwater driller Seadrill, proppant sand manufacturer High Crush Partners, and upstream partnership Lin Energy helped our readers avoid declines of 90% or more and the elimination of dividends and distribution income. All of these buy and sell calls, and many more, are a matter of public record through numerous appearances I've had on CNBC, Bloomberg Television, radio shows all over the US and Canada, referenced in articles appearing on Seeking Alpha, CBS Market Watch, and Barron's, through investment research services I've founded, or my 2 investment books. However, that's not why I created this letter, and I certainly have no desire to boast or brag. I reference our success and experience calling some of the biggest cycles and trends in global markets, because our research confirms that some of the most powerful cycles we've followed for decades will converge over the next 2 years. I'm not exaggerating when I tell you this will mark one of the biggest money-making opportunities of my career. However, I'd be remiss if I didn't also warn you that it's one of the most dangerous parts of the economic and market cycle. To make matters worse, many investors are making a crucial mistake right now that could devastate long-term returns, threaten retirement goals, and income potential. And that's why I've spent a significant amount of time and money over the past 9 months preparing this letter, explaining all these risks and opportunities, and outlining 5 simple profit steps I'm recommending right now. Listen, earlier this week I released a special 93-minute strategy primer for VIP charter members of Deep Dive Investing Research, outlining my simple 10-point checklist for spotting recessions and bear markets. And I even go through the basics of my research on global market cycles and a few simple indicators you can use to pinpoint exactly where we are in the current cycle and how to profit from it. I created this presentation summarizing many years of research and experience in the U.S. stock market cycle to answer the simple dilemma facing so many investors today. And that's how to hang on to stocks for as long as possible in the cycle, to take full advantage of the melt-up market rally, while still spotting downturns soon enough to avoid the vicious bear markets that always follow these booms. Look, normally I would make a recording like this available free of charge. However, I believe this information is so important and so crucial to your financial well-being that I couldn't just hide all of it behind a paywall. So I've decided to release one powerful part of my 10-point checklist today as part of this free presentation. And for a strictly limited time, and only through this website, I'll explain how you can gain immediate access to this entire strategy session and my full 10-point checklist, absolutely risk-free. And I'll also explain a total of 5 profit steps I'm recommending to readers of Deep Dive Investing right now. I promise you I won't waste your time. Watch my short presentation through to the end and decide for yourself if I'm for real or just full of hot air. Hello, my name's Elliott, and this is Deep Dive Investing. It's December 2017. We're going to take a little different look at the market today than we normally do in Deep Dive. We're not looking at an individual sector or group of stocks, but we're looking at the market as a whole. And in particular, today's issue is a response to a question I've been getting a lot lately, which is, are we in the midst of, do we still have more upside for the overall market right now? Are we going to see a melt up, in fact, in the S&P 500, where we see very strong gains, which is typical for the latter stages of a bull market? Or, in fact, is this expensive market, that's one of the longest bull markets in history, poised for entering a bear market, poised for a major collapse? And it's a very complicated topic, of course, but I do have a number of indicators that can help you determine when the bull market is getting on its very last legs or when it's still safe to own stocks. And today I'm going to look at a basic 10-point checklist that I've used in one form or another for years to determine when it is no longer safe to own stocks as a whole. So, this is, as I said, is a question I've been receiving a lot lately, and I think a lot of it has to do with just the age of this bull market. Stocks have been rallying. We haven't seen a 20% or larger pullback in the broader stock market, in the S&P 500, since 2009. So this rally is actually over 3,200 days long, which makes it the 3rd longest rally in U.S. stock market history. The 1990s, of course, being the longest, and the rally that started in 1947 being the 2nd largest. Now, come next summer, we'll have surpassed that 1947 rally, and soon thereafter, in about a year's time, we'll be surpassing that 1990s rally to be the longest rally in history if this bull market continues. So, a lot of investors look at that and they say, this is a really long rally. Maybe we're due for a bear market just because this bull market is so old. The economic expansion is so old. It started in June of 2009, and we haven't seen a recession since then. So we're going to get up on 9 years old for the economic expansion, and we're pushing, and we're going to be pushing 10 years old in 2019 for the overall market rally. So it is one of the longest in histories, and the economic expansion is one of the largest in U.S. market history. So that leads a lot of people to wonder whether we might be due for a bear market or at least a very major pullback. At the same time, stocks are definitely not cheap. Depending upon what valuation metrics you want to look at, they're either as expensive as they've ever been or as expensive as they've been at any other time in market history except for the height of the tech bubble in the late 90s and early 2000s. So I put up two measures of market valuations here, two common measures of market valuations. The black line on your chart is the forward price to earnings ratio for the S&P 500. So it's the current price of the S&P divided by analyst consensus expectations for the next 12 months worth of earnings, the next year worth of earnings, next 4 quarters of earnings. And you can see that we're trading at a little over 20 times earnings right now in the S&P. The only other time in market history where that's been the case for any length of time anyway is from 1998 up through early 2000. So again, the height of that 90s boom and tech bubble, and of course the subsequent bust. The blue line you see on your chart is the S&P 500 price to sales ratio, or price divided of the S&P 500 divided by the revenues. And what you can see is that's at 2.25 times revenues, and that actually is tied for the peak which we saw back in late 1999 and early 2000. So at the very least, stocks aren't cheap, and in many measures, they're actually near record expensive. So again, that's something that leads investors to wonder if perhaps we might be due for a bear market, for a large decline such as what we saw back in 2007 to 2009, just based on the age of this bull market and valuations in the stock market. And of course, bear markets are extremely painful to hold stocks during bear markets. And what you can see is that the average decline, I looked at all 12 bear market cycles since 1937, and the average decline in a bear market is over 35%, and it lasts about 14 months, so a little over a year. So this is a very painful time to own stocks. In fact, if you can just avoid the worst bear markets, these 12 major bear markets since 1937, you obviously would have outperformed the market by a sizable margin just by avoiding the majority of the bulk of these declines during these phases. And the other thing to look at on this chart is the left-hand column. The thing to remember about bear markets is they don't always occur at the same time as a recession, or the market doesn't always peak ahead of a recession, but it usually does. And more severe bear markets occur in the context of an economic downturn or recession. So out of the last 12 recessions in the U.S., which as I said goes back to 1937, these are the last 12 bear markets in the U.S., 10 of them occurred in the context of a recession in the U.S. There only really are 2 exceptions. They're the bear market that began in February 1966 and the bear market that began in August of 1987, which you'll probably remember actually occurred right before the tail legs of that bear market was actually the 1987 crash, the October 1987 crash, Black Monday and all that. That was actually the shortest bear market, one of the shortest bear markets in history, only lasted about 3 months, but it was pretty severe, the market falling by about a third. But those are the only 2 exceptions where there was no recession, yet the U.S. went into the U.S. market, the S&P 500 saw a bear market declining more than 20%. There are also, in most cases on this chart, on this table, as you can see, the peak in the stock market occurs before before the U.S. economy actually enters recession. So the market is a forward-looking indicator. You'll often hear that said, where it peaks out before the U.S. economy actually begins to contract. So on average, it occurs about 9 months before the bull market peaks out, about 9 months, 7 to 9 months before the U.S. economy enters into recession. There are two occasions, which you see on this table, 1946 and 1961, where the market actually peaked out after the U.S. economy entered recession. And these are very unusual circumstances. In 1946, there was actually a recession that ended in October 1945, and another one started in November 1948. So while the market kind of peaked out after the U.S. actually exited that 45 recession, it also peaked out a couple years before the U.S. entered another recession. So that's questionable whether you consider that the market peaking out after the recession. The 1961 cycle is a little bit more clear-cut. The recession actually ended in February 1961. And as you can see here, the market didn't peak until December 1961. So that's pretty clearly happened. That bear market happened after the U.S. economy exited recession. But in most cases on this chart, you can see two things. One, the bull markets tend to peak out before the U.S. economy enters recession. That has been the case particularly since 1950, totally exclusively. And almost all cases on this chart, the U.S. economy, the U.S. bear markets occur in the context of a U.S. economic downturn. So the economy and the stock market head down together, and the stock market tends to peak before the economy does so. So those are the key takeaways from that. So obviously, we're worried about the length of the bull market that we've seen over 3,200 days. We're worried about valuations in the S&P 500, and we're worried about the severity of bear markets in history, over 35%. At the same time, and I think the flip side of this question I'm getting a lot is that investors don't want to miss out. They're worried about missing out on the upside. The final act of a bull markets almost always end with a bang, not a whimper. The last 12 months of bull markets of the post-war era, the average gain is 25% including dividends. And the last 24 months of bull markets since the 1930s is about a 58% gain including dividends. What this chart on your screen shows is I created a composite, an average of all bull markets since the 1930s. And I looked at the final 500 days before the peak in the bull market and the first 250 days of the bear market. And this is only prices, has no dividends included. You can see that on a price-only basis, the gain in the last 500 days of a bull market is roughly 50%. As I said, it's 58% if you include dividends. And the first year of the subsequent bear market, you still don't give back all of those final bull market gains. And in fact, if you look here, the first 120 days of a bear market, you don't even give up the last year worth of gains in the bull market. So the point here is that you don't want to sell out too early in a bull market, because if so, you miss out on some of the best gains of the entire cycle. In fact, on average, since the 30s, the final 2 years of a bull market accounts for more than 40% of the entire cycle gains. So selling out too early is actually more painful than being 3 to 6 months late selling out. So don't try to be early calling the top. If you do, you're going to miss out on the very best gains that the market has to offer, at least from a historical standpoint. So the key thing the first step of all is you want to avoid those recessionary bear markets. So we don't want to sell out too early, but if the U.S. economy is about to enter a recession, and we're about to enter one of those really ugly cycles I showed you, the 12 ugly cycles I showed you since 1937, where the 10 of the 12 bear markets, where we've actually seen a recession and a bear market occurring at roughly the same time. That's when you want to get out of stocks. You want to avoid those recessions and bear markets. The combination there is deadly. That's really where you're going to see a lot of pain. But you don't want to sell out too early and just be selling out on a minor dip, because you might miss out on that most profitable time to own stocks. So this first step is to avoid owning stocks when a recession is imminent. And so the very most important step of this entire process is using some simple indicators I'm going to show you to tell you when a recession, a U.S. economic downturn, is imminent. If you can just say 6 to 9 months before a recession starts, a recession is coming, then you would have avoided the most painful cycles that we've seen since the 1930s. So that's the key. If you can spot a recession coming, you can spot the most painful bear markets, and you can get out of stocks before it's too late, but also hold on to make sure you get full advantage of the end of the bull market, which again is the most profitable time to own stocks. The first indicator I want to talk about is one that has a high degree of reliability. It's very simple, but it also has a high degree of reliability going back to 1959, which is when this indicator was first compiled. So it has a long history of being right, and it's very unambiguous as to what it's telling you. The signals it gives you are very unambiguous. And that, in my view, is the ideal economic indicator. And what it is it's the year-over-year percent change in the Conference Board's U.S. Leading Economic Index. And here's how I use it. I look at the year-over-year change in LEI, and you can find this indicator, by the way, for free on the Conference Board's website. You go there every month, they have some commentary about this indicator. In a minute, I'm going to show you a little bit more of what goes into the calculation of LEI. There are 10 different indicators in the Leading Economic Index. And what I do is I look for a fall from above zero on a year-over-year change basis to below zero. So when this indicator drops to zero or below, that tells you that there's a very high probability of a U.S. recession starting within 12 months. So you look at this chart here, you'll see that, and I took just as an example, the period from the mid-1990s all the way up through 2002. And what you can see is that in October 2000, the LEI dropped below zero. And the U.S. economy entered recession in March 2001. So it gave you about a 5-month lead time on that cycle that the U.S. was headed for recession. If you'd sold out when LEI dropped below zero, you would have gotten in after the top of the bull market, because the top was actually back in March of 2000. But you would have avoided most of the pain of a bear market that ended up involving about a 50% decline in stocks, and in particular technology stocks got really wiped out in that bust. So this indicator gave you about a 5-month lead time to avoid most of the pain in the stock market. At the same time, if you'd waited until this indicator told you that a recession was coming, you still would have caught that tail end of the 1990s and early 2000 bull market, which was a very, very powerful rally that you didn't want to miss out on. So that's the 2000 highs. And this is certainly, as I said, it's an indicator that goes back to the late 1950s. So let's look at the very severe 1973 to 1975 recession. This, by the way, was one of the worst recessions that we've seen since the Great Depression. Some people even believe that this recession was more severe than the economic downturn we saw in 2007 to 2009. It was close, there's no doubt about it. I tend to think that 07 to 09 was a little worse, but this recession was among the worst in history, except for the Great Depression. The stock market, the S&P 500, fell more than 48% in the context of this bear market. So it was also one of the largest bear markets in history, the only real exception being that 07 to 2009 bear market, the great recessionary bear market and the credit crunch. And in this case, the LEI year over year hit zero in October 1973 and fell below zero in November. The U.S. recession began in November 1973, so this indicator gave you about a 1-month lead time on that downturn. So again, just looking at the year-over-year change in the leading economic index put out by the Conference Board tells you when the U.S. economy is about to enter a recession. Now let's look at the track record specifically so that you can see that I'm not just cherry-picking a couple of instances where this indicator's been very good. And this chart shows, and again, as I said, this indicator only goes back to 1959. So I looked at every case going back to 1959 where the year-over-year change in LEI fell from above zero to zero or below. And that first column on this table, the signal date, is the first month where that happened. So it happened in February 1967,
October 1969, and so on. And you can see that in every case that this happened, it was followed by a recession in the US except for two false signals, which were 1967 and 1989. And the lead time was between 0 and 16 months. So on average, it happens within about 9 months or so of this signal. The US enters a recession. And it's called every single recession over this time period. So every single recession that's happened, this indicator, this very simple indicator, has called the recession before it happened. And there were only two false signals over this roughly 50-year period. So that's a pretty good track record for what's a very simple and unambiguous indicator. One of the things I like about LEI, looking at the year-over-year change so much, is that unlike so many indicators out there, especially so many economic indicators out there, it is totally unambiguous. You can see exactly what's happening. There's no room for interpretation or qualitative analysis. The year-over-year change is either above 0 or it's below 0, and it gives you a very clear signal, which is almost all the time absolutely correct. There have been 7 recessions over this period. It's called every single one, and only 2 false signals.
So there you have it. 10 of the past 12 bear markets in the S&P 500 have occurred in the context of a U.S. recession. That list includes the most vicious bear markets of the past 80 years, like the 48.2% collapse in the S&P 500 in the 1973 to 75 bear market, and, of course, the more recent 56.8% pummeling in the S&P 500 during the 2007 to 2009 financial crisis and Great Recession. I'm not exaggerating. Spotting these recessionary bear markets in time to take action in your portfolio is crucial to long-term investment success. However, history shows that if you sell stocks too early because they're expensive, you're making a crucial mistake and risk missing out on the final euphoric melt-up rally that's characterized every bull market of the past 80 years. The fact is that stocks are always expensive at this stage of the cycle. Simply put, the year-over-year change in the U.S. leading economic index, compiled by the Conference Board, can help you spot U.S. recessions months before they start. And that allows you to stay invested in the most profitable part of the cycle while avoiding the worst bear markets. And earlier on in this presentation, I promised you I'd explain a little bit more about my 10-point bear market checklist and a total of 5 profit steps I'm recommending to members of Deep Dive Investing to take advantage of the cycle right now. Profit step number 1, my 10-point checklist for spotting bear markets and recessions before they happen. Listen, no indicator is perfect. And while I believe the year-over-year change in the U.S. leading economic index can help you spot recessionary bear markets before they happen, I've also developed 9 additional checklist indicators to fine-tune my approach. I developed this checklist through a careful study of close to a century worth of economic and stock market data in the United States, Japan, the United Kingdom, and continental Europe. For example, I use monthly data on LEI to help me spot recessions earlier, much earlier than the year-over-year data I explained in this presentation. However, monthly data is more noisy and causes a lot more false signals. So you'll need to use another indicator in a very specific way to help screen out the bad signals. Plus, the conventional definition of a bear market, a 20% plus decline in stocks from a closing all-time high, is a little arbitrary and, quite frankly, totally insufficient. After all, the correction back in 2011 and 2012 lasted nearly a year and saw the S&P 500 collapse 19.4%, with around half of S&P 500 companies declining by 30% or more at one point during this correction. And corrections in 2010 and 2015 through 2016 saw the S&P 500 lose 16% and 14.3% of its value respectively. So let me ask you this, wouldn't it be useful to spot these mini bear markets so you can take action, even though they aren't technically full-blown bear markets? Well, in my 93-minute bear market checklist presentation, I'll explain a few simple indicators I use that can also help you spot major market pullbacks and take action to protect your portfolio. Listen, I don't have time in this short presentation to go through all the points on my 10-point bear market checklist and how they work. However, I'd like to give you immediate access to the full online presentation today, plus a quick start 2-page executive summary, all with absolutely no risk or obligation. I'll show you how to get my 10-point bear market checklist in just a few moments. However, first, that brings me to this, profit step number 2, how to play this rare quadruple sync cycle with this unique group. Listen, business, commodity, and market cycles are a fact of life. However, economic and market cycles in different parts of the world are not always aligned. Among the world's major economies, there's usually one that's acting as a global growth engine, and another that's the sick man of the world. However, here's what's crucial. The most powerful cycles show synchronized global growth. In other words, when a handful of simple leading economic indicators I watch for the big 3 developed economies, plus China, line up, typically only once or twice a decade, that's when investors can expect the biggest and most impressive gains in the stock market. And when all 4 legs of the quadruple sync indicator line up, I look at the industrials. The industrials are a downright weird economic sector. The group comprises everything from defense firms to transportation stocks like rails and airlines, to firms that make heavy machinery and factory equipment, even waste management companies, employment agencies, and firms that maintain uniforms are part of this catch-all market sector that accounts for around 10% of the S&P 500. Listen, I love the industrials for just that reason. It's full of a bunch of companies that many investors overlook because they defy easy classification. And it's full of quite a few firms that most investors may have never heard of, but are a crucial part of their everyday lives. However, the real reason I'm so interested in the industrials right now is that the group is the economic sector within the S&P 500 that's most leveraged to industrial production and manufacturing activity. It's the single group that tends to perform best when the global economy is experiencing synchronized growth. I don't have time in this short presentation to go through all the indicators I watch and explain all the industrial stocks I'm recommending right now. However, I walk you through all you need to know and the 5 specific stocks I'm recommending right now in a detailed 90-minute strategy session I recorded on this group. The best part is that for a strictly limited time, I'd like to give you access to this presentation, plus a quick start bulleted executive summary of all the main points, all with absolutely no risk or obligation. I'll show you how to reserve your exclusive access credentials risk-free in just a moment. And that brings me to this, profit step number 3, bottoms up. Listen, some of the best known investors in the world, including the Oracle of Omaha himself, Warren Buffett, are considered value investors. And buying cheap, out-of-favor stocks is a proven investment strategy. Just look at this shocking example. One of the most common valuation metrics for individual stocks is the price-to-sales ratio, the price of a stock divided by sales per share. Let's assume that starting in January 1997, an investor bought the 50 S&P 500 companies with the lowest price-to-sales ratios. Each quarter, this investor rebalanced that portfolio to own only the 50 stocks with the lowest price-to-sales ratio. Look at this result. This simple strategy would have turned $10,000 into over $135,278 since the end of 1996, compared to just $50,000 for the same sum invested in the S&P 500. However, most popular valuation metrics, including price to earnings, price to sales, and price to book value, all ignore one absolutely critical fundamental of successful stock selection. It's the single market factor that has brought more mighty companies to their knees, and it has ruined more great fortunes over the years than any other. I'm talking about debt. So let me ask you this. We all know excess debt is a huge problem for a company, so why would we use valuation metrics that don't take a company's debt burden into account? My research shows there is one valuation metric that does take debt into account. It's called enterprise value to free cash flow. And it's one of my favorite ways to identify high potential stocks right now. In fact, over the past 18 months, selecting S&P 500 stocks with the lowest valuation on this metric has trounced the broader market by nearly 10 percentage points. I want to send you all my research on this powerful value metric today, plus 4 stocks I'm recommending right now that screen well on this measure. And in just a few minutes, I'll explain how you can gain access to this crucial research immediately with a no-risk, no-obligation trial charter membership to deep dive investing. However, first, that brings me to this. Profit step number 4. To make money and earn hefty yields in real estate, think small and follow our checklist. Stephen Ross, Richard Lefrak, Ted Lerner, and of course, US President Donald Trump are all among the world's billionaires who made their fortunes primarily through real estate investing. The good news, you don't need to be a billionaire to make serious cash and earn impressive yields in real estate. Thanks to the Real Estate Investment Trust, or REIT structure, created in the US way back in 1960. REITs are nothing more than publicly traded companies that own or finance income-producing real estate properties, including apartments, office buildings, shopping malls, even cell phone towers and data centers. However, I must warn you, most REITs today are very, very expensive. You're paying more for less yield and income than at almost any other time in the history of the industry. However, that doesn't mean there aren't bargains in this group. You just have to look beyond the headlines and the handful of large REITs most investors buy. You see, my colleague and income investing expert Roger Conrad has developed a 4-part checklist to identify the best bargains in the group. This simple checklist pointed him and his loyal readers to the data center REITs back in early 2014. And this same process is guiding him to some incredible bargains today. I don't have time to go through all the details in this letter, however, here's the gist. A strong underlying business and visible upside to rents. Look for REITs that cover their distributions using funds from operations, leaving ample capital left over to fund growth and expansion. Excess debt is the biggest enemy for the group. Look for REITs with below average debt loads and relatively few near-term debt maturities. Finally, calculate the growth yield. Add yield in percent to annualized distribution potential, and focus on REITs where the growth yield adds up to 10% or more. Look, there are 224 REITs in North America alone, and only a handful fit Roger's stringent checklist criteria. Many of the best REITs to buy right now are not the large cap names that dominate the S&P 500 real estate index. It's not the stocks that are major components of the popular ETFs and ETNs that so many REIT investors buy in the name of diversification. As I explained earlier, many of these popular and widely held REITs and exchange-traded products that are trading at near record valuations actually represent potentially dangerous investments. Today, I want to give you access to Roger's detailed presentation on REITs, including his top high-yield, fast-growing REIT picks to buy right now, plus a rundown of some of the most dangerous and overvalued REITs you should sell right away before it's too late. Best of all, for a limited time, this detailed REIT strategy session and quick start executive summary is available with absolutely no risk or obligation only through this website. Profit step number 5, my favorite sector for 2018. There's little doubt you've heard of Federal Reserve Chair Janet Yellen, who will step down in February to be replaced by Jerome Powell. And you've probably seen Steven Mnuchin, the Secretary of the US Treasury, on financial television or talked about on the news. And you've probably been following the progress of tax reform over the past few months. Maybe you've even been following the prospects of the Financial Choice Act, passed by the US House of Representatives on June 8th, that would repeal or rewrite many of the key provisions of the 2010 Dodd-Frank Financial Reform Act, passed in the immediate aftermath of the financial crisis and Great Recession. However, I promise you that these 3 men will have a major impact on your portfolio, directly or indirectly, over the next 12 months. You see, the mainstream media tends to focus on big bang legislation efforts like repeal and replace, major presidential appointments like Secretary of State and Treasury, and of course, more sensationalist DC drama, such as the 10-day career of Anthony Scaramucci as White House Communications Director. However, a lot of the real news out of Washington, the sort of trend that could make or lose you some serious cash, is subtler and behind the scenes,
even a little wonkish. It doesn't get talked about much in the media, even the more sober and dispassionate financial news programs and publications, for the simple reason that it's usually downright boring. However, these overlooked, under-the-radar appointments and policy shifts can be much more important than the latest sensationalist battle between Republicans and Democrats. Let me give you an example. Thomas Curry was appointed as Comptroller of the Currency by former President Obama and assumed the position on April 9, 2012. Prior to that role, Curry was on the board at the Federal Deposit Insurance Corporation, a key federal banking regulator. Curry first entered politics in Massachusetts back in 1982 at the age of 25 and has never worked in the banking industry. In short, Thomas Curry is a lifelong regulator. The 2010 Dodd-Frank Act handed the Office of the Comptroller of the Currency significant regulatory power over the U.S. banking industry, and Curry made waves in the industry in 2015 when he proposed tougher regulations and capital controls governing banks' commercial real estate lending practices. The result, a sizable sell-off in shares of U.S. regional banks with larger exposure to CRE loans. However, Stephen Curry's 5-year term expired this year, and he stepped down in May. President Donald Trump's nominee to replace him, Joseph Otting, was CEO at One West Bank, a regional bank based in Southern California with around $23 billion in assets. From 2010 to 2015, up until the bank was acquired by CIT Group. Otting's long career in the regional banking business suggests he'll be far more sympathetic to the industry, especially banks regulated by the OCC. So who is Randall Quarles? The Vice Chairman for Banking Supervision at the Federal Reserve is the chief banking regulator at the Fed and has broad powers in designing the annual comprehensive capital analysis and review, or stress tests, administered by the Fed. These stress tests determine, among other things, how much capital banks can return to shareholders via dividends and share buybacks. The Dodd-Frank Act of 2010 created the post of Vice Chairman for Banking Supervision. However, former President Obama never appointed anyone to the post. Instead, former Fed Governor Daniel Tarullo assumed the role and was known for taking a very tough regulatory stance on large U.S. banks. Tarullo stepped down in April, and President Trump has formally nominated Randall Quarles, a Wall Street attorney who founded a private equity firm and held posts in Treasury under both Bush administrations. Quarles can make significant refinements of the CCAR process without approval or new legislation from Congress. In fact, in June, Treasury Secretary Steven Mnuchin released a 149-page report titled "A Financial System That Creates Economic Opportunities," proposing more than 100 changes to U.S. financial regulations aimed at the banking industry. The industry has been seeking many of these changes and refinements since the day the Dodd-Frank Act was signed into law more than 7 years ago. However, here's the big news. More than 80% of these changes will be possible without any new legislation from Congress. Most of these regulatory changes are possible through appointments President Trump has already made or soon will, such as Randall Quarles at the Fed and Joseph Otting at OCC. The result, you're probably not going to hear much about financial reform in the mainstream media for the foreseeable future because there will be no Big Bang repeal or replacement for Dodd-Frank. Many investors will believe everything is simply stalled by partisan bickering in Washington, D.C. However, I guarantee you there are already massive regulatory changes underway that are forming a powerful tailwind for certain select U.S. financial firms. I've created a detailed video strategy session and slide presentation that explains all the key trends you must understand, including the name of a small, under-the-radar, Connecticut-based bank that's a leader in one of the fastest growing markets in the U.S. today, a triple over the past 5 years alone, that's set to get a big and bipartisan boost from Congress next year. The real and safe way to profit from healthcare reform, even if the House and Senate can never agree on a healthcare reform package. How one sentence buried on page 25 of this obscure document released by the Fed could unleash a multi-billion-dollar merger boom in the financials over the next 2 years, plus a handful of names we regard as the most likely targets at very fat premiums. The $2.5 trillion savings glut that's keeping down expenses for the nation's banks, powering a wave of better than expected earnings results that few investors recognize. If you've ever wanted to jump on a hot new tech company like Facebook, Uber, or Snapchat at deeply discounted prices before it comes public, here's how. Note, you don't need an 8-figure investment account to benefit. I'd like to send you all my detailed research on the financial sector, including 5 under-the-radar names I'm recommending you buy right away to benefit from the changes already underway in Washington, so you can get started profiting today. Better still, for a limited time and only through this website, I want to offer you access to all my research and recommendations risk-free for 60 days, as part of a special 60-day risk-free trial to deep dive investing, available only through midnight on Christmas Day, that's December 25th, 2017, and exclusively through this website. Listen, I know you've probably been reading a lot about how overvalued the stock market is right now. However, as I explained at some length in this letter, stocks always look expensive in the final stages of a major bull market, such as the run-up in the S&P 500 since 2009. However, missing out on just the last 2 years of a bull market can be a very expensive mistake. Since 1937, investors selling out too early have given up average gains of 58%. No investor can afford to give up on a return like that. However, it's absolutely crucial that you also avoid the bear market that always follows market booms, such as we're witnessing right now. The average bear market in the US wipes out more than 1/3, that's 35.5% to be exact, of the S&P 500's value, and lasts an average of 14 months. In this presentation today, I've shown you a little bit more about my 10-point checklist for spotting bear markets before they start wiping out your wealth. My 10-point checklist is one of the indicators and market cycles I've used to make some very profitable market calls over the years, including the turn in the broader market nearly 9 years ago and the big collapse in oil prices and energy stocks that started in the summer of 2014. Simply put, I want you to be on the right stocks and sectors to take full advantage of this cycle as long as it lasts, and still be able to get out of the market or hedge your downside before the big bear market starts. In this letter, I've given you an overview of my 10-point bear market checklist and 5 profit trends my colleague Roger Conrad and I are recommending in our new deep dive investing service right now. I don't want you to miss out on this opportunity, and to help you profit from what I believe could be a very dramatic rally, I'm going to do something I've never done before for this service. Please just give the work I've done a look. I believe you will have all the information you need at your disposal. The best part is you can take a look at my research and receive everything I've mentioned here today for 2 full months, that's 60 days, at absolutely no risk or obligation. Simply click the Start Your Risk-Free Trial button below this video and let me know you'd like to take a trial subscription to Deep Dive Investing today, and I'll rush you a username and password for our secure website, granting you immediate access to all the detailed presentations and strategy sessions I've outlined in this report, plus concise executive summaries for all of our themes and recommendations to help you get started profiting immediately. The list includes my 10-point checklist for spotting painful bear markets before they happen, how to play this rare quadruple sync cycle with this weird little market sector, bottoms up, the right and wrong way to measure value right now, high income and low taxes, Roger Conrad's checklist for identifying winning REITs and how to avoid the pitfalls, plus my favorite sector for 2018. Please just give the work I've done a look, and I believe you will have all the information you need at your disposal. The best part is you can take a look at my research and receive everything I've mentioned here for 2 full months at absolutely no risk or obligation. Simply click the Start Your Risk-Free Trial button below and let me know you'd like to take a trial subscription to Deep Dive Investing today, and I'll rush you a username and password for our secure website, granting you immediate access to all the detailed presentations and strategy sessions I've outlined in this video, plus concise executive summaries for all of our themes and recommendations to help you get started profiting immediately. To my knowledge, there's no financial advisory service on the market today quite like Deep Dive Investing. We don't just scratch the surface of the themes, industries, and stocks we cover. In each issue, we want to give you a thorough understanding of the fundamentals that drive our big idea investment themes, so we'll have the conviction to benefit from our best of the best ideas and recommendations. Roger and I attend industry conferences, participate in management conference calls, scrutinize financials, and leverage our contacts across the industry to track down the data, charts, and key fundamentals you need to make an informed, high-conviction buy or sell decision. It's like being a fly on the wall and receiving an executive summary of all the best ideas and research presented at our weekly company investment meetings. And all our deep dive research is delivered to you in a novel and easily digestible format. Issues are delivered at least 20 times each year in the form of a detailed video presentation that includes a slide deck packed with all the charts, financial data, valuation metrics, and background research you need to gain conviction and an understanding of our top ideas. And just to get you up to speed so you can act quickly on our picks, we publish a short, bulleted executive summary of our main conclusions and recommendations with each new issue. Roger and I have been discussing a service like this on and off for years, and we just launched Deep Dive Investing Research about 6 months ago to a small group of beta testers. It's quickly become a hit with our readers, and we've decided to expand the service even further. Specifically, we already track the performance of all of our recommended stock ideas in Deep Dive. However, we just announced the launch of our exclusive focus list. The focus list includes a short list of the specific stock recommendations we believe to be most timely based on a host of technical and fundamental factors we review every week. These are the themes and stocks you should buy first to take advantage of our advice. And we're even more excited about our Managed Portfolios feature that we'll be rolling out in the service over the next few weeks. You see, Deep Dive Investing isn't just another stock tout tip sheet like so many investment research services on the market today. We believe that recommending stocks to buy is just the first step to investing success. We want to help you decide how much to allocate to each of our recommendations, when to buy these stocks, how to buy our recommendations, specific buy prices and profit targets, how to hedge yourself and protect your downside in weak markets. To guide you, we're creating a group of separate managed portfolios, each aimed at investors with different objectives and risk tolerances. For example, our absolute return portfolio is for investors looking to earn a positive return in just about any market environment. It includes specific recommended allocations to a portfolio of stock recommendations, plus market hedges aimed at protecting your downside during market downturns. In short, we believe the absolute return portfolio will help you take advantage of the melt-up market rally today and protect your downside during the next bear market phase. And then there's our enhanced income portfolio we're planning to launch over the next few weeks. The enhanced income allocation is aimed at our readers who like to buy and sell options on stocks and indices. Specifically, we recommend option strategies such as selling puts and selling covered calls to squeeze more income and more profits out of our recommendations. Deep Dive Investing includes specific portfolio recommendations and allocations for investors with different goals and objectives, and will never leave you hanging or guessing about which stocks to buy or how much to invest in each recommendation. I guarantee it. The truth is that once we launch these new features for the Deep Dive Investing service, we'll be raising the membership price to $19.99 per year or $599 through our quarterly billing option. However, only through midnight on Christmas Day, that's Monday, December 25th, and only through this website, we've decided to offer Deep Dive Investing trial memberships at our special charter rate, representing a huge discount to that full membership price. Even better, charter memberships come with our popular Forever Guarantee. Simply put, should you decide to continue with your Deep Dive Investing membership beyond our trial period, we'll lock in your annual or quarterly rate for as long as you choose to remain a member. You will never be asked to pay a dime more than our charter rate to renew your subscription, regardless of what we're charging new members in future. And we realize it may take you some time to review our deep dive investing service and start taking advantage of all our recommendations and advice. So, for a very limited time, we're extending our no-risk money-back guarantee from 30 to 60 days. Start your risk-free trial to deep dive investing today by clicking the exclusive button below this video and review the service for 60 days. If you find deep dive membership isn't for you, for any reason whatsoever, or if you think it's not worth every penny of the subscription price, simply cancel in the first 60 days and I'll refund your entire subscription rate with no questions asked. I guarantee it. Look, Roger and I have charged as much as $999 per attendee to give a detailed market presentation, including our top recommendations and the profit themes we're following. Just the sort of presentations you'll be receiving from me, Roger Conrad, or both of us together every single month as a member of Deep Dive Investing. And services that offer specific recommended portfolio allocations and strategies for selling covered calls or puts to earn additional income from stock recommendations sell for more than $4,000 a year. So we believe our regular membership rate of $19.99 a year or $5.99 per quarter already represents a more than fair price for our readers. However, as we roll out the new features of this service, we've decided to create a special charter membership category at a roughly 50% discount to our regular rate. That's our 60-day risk-free trial charter membership rate of just $9.99 per year or $299 per quarter, available only through midnight this Christmas Day, December 25th, and only through this website. As I mentioned before, we're only asking that you give Deep Dive Investing a test drive. Sign up for a trial membership today using the Start Your Risk-Free Trial link at the bottom of this page. Take advantage of our special charter rate, all our features and model portfolios, and check out our detailed archives, including all the strategy sessions and themes I've covered in this letter today, and only then decide. If Deep Dive Investing isn't for you, cancel in the first 60 days and receive a full refund of your membership rate with no questions asked. Please click the Start Your Risk-Free Trial button below to get started today.